using back data to kind of forecast that, which a lot of times doesn't work. But, if their target's 3%, sitting at this level is probably a little high. I think we should, start to see some rate cuts this year, but time will tell. Next month on the call, I think their meeting is after our call. So I don't know if we'll have an update on that, but I'll keep you posted on the rate cuts. The yield curve still slightly inverted. Again, the short end here is being held up by the Fed funds rate. You can kind of see the 2 year has been, last month was at 3.7. We're sitting at about 3.8% on the 2 year. Historically, the 2 year has been a good guide for the Fed funds rate. So if that holds true, we would expect the Fed funds rate to drift closer to that 2 year rate in the near term here. So that would mean 1 or 2 rate cuts over the next couple months and get us to about a 3.7, 3.8% Fed funds rate. If that happens, I imagine the 2 year and 3 year would also drift. They could stay pat. They might drift a little bit higher. Eventually, we expect to kind of get to this somewhat, maybe not starting down there, but a normal sloping yield curve. Maybe we're going to be, at this level. That could be one curve. This could be another curve, a little bit flatter curve down here, even a more flatter curve. We don't know the shape of it, but a normal sloping curve where longer interest rates pay more interest than shorter interest rates. Where now we have the 3 month, 6 month, 1 year paying more than a 2 year or 3 year treasury bond, which is not really normal. You get paid more for the longer of the maturity of the bond that you buy. International stocks are still doing very well. We talked about this last month. So again, this is one of the reasons why we